Good morning everybody and welcome to this European session on Tuesday the 10th of September. Hope you're having a fantastic trading week so far and ready for another incredible week of trading opportunities as we come into some of the higher impact news announcements affecting the flows of the financial markets. So let's dive in and see what's been happening overnight. Overnight, we had some data from China showing that its exports are actually beating expectations. So China's exports rose 8.7% year on year in US dollar terms in August, and this was higher than the forecasted growth of 6.5%. Now, imports grew only by 0.5%, which was less than expected, the 2% increase from a year ago. Now, even with exports beating expectations, there are still concerns that remain over its imports and whether there is enough domestic demand to avoid a deflationary cycle. And this is a situation where interest rates are at 0%, but the general prices of goods and services is actually declining and the unemployment rate is quite high. So this has continued to weigh on the Chinese stock markets, and if you have been trading stock markets, the Chinese stock markets have actually been trading at multi-year lows in fact. And what's happening in China does have a big impact on other currencies because it exports so many goods to other countries, so it can be a good indicator of growth within those other countries, especially the Australian dollar. We had a bit of an uptick in the Aussie dollar overnight because of the better than expected export data coming out from China. So there is a loose correlation there, but because China's economy has been struggling for quite some time, it's much less sensitive to it now. So we're still continuing to look for weakness in Chinese stock markets, but if there are some significant changes in the data, then we need to be looking at the Australian dollar, which can be heavily influenced by what's happening in China as well and the exports that go to Australia. So if there aren't any really big opportunities around these kind of market themes, of course I'll do my best to let you know about them, and make sure you're tuning into the live trading webinars as well to capitalize on any opportunities developing throughout each trading day. We also have the all-important US CPI report being released today at 1:30 p.m. British Summer Time. And the CPI report basically stands for Consumer Price Index Report, and it's released by the Bureau of Labor Statistics in the US, and it measured the change in the price of goods and services purchased by consumers. And consumer prices account for the majority of overall inflation, which is then used to determine interest rate policy. Now, the year-on-year data from June was 3.3%, July 3%, August 2.9%, and is now forecasted in September to be 2.6%. So overall, inflation has been falling in the US. And this is why there's been a massive fall in the US dollar. That's where the big trends have been over the past several months, because the falling inflation is when what can help the Federal Reserve to start cutting interest rates, where there's a widely expected interest rate cut of 25 basis points later in this month, although now there is an increase in chance of even a 50 basis point interest rate cut. Now, the key here with these kind of news announcements is that we're not again trying to predict what the news announcement is going to be. We're not trying to react in just nanoseconds and compete with the algorithms who are readjusting portfolios or any surprises. What we want to look for is any surprise from what people are expecting, and then any follow through from that surprise. We know most market data is already priced into the market, right? Inflation has been falling. People are expecting the Fed to cut interest rates. The US dollar has been falling, right? Well, obviously, we saw a huge round of profit taking in the US dollar pairs last week, where now they've put in some trend reversals. We're more likely to see more ranges develop than trends, because we're coming into these higher impact news announcements where some people may take some profits off the table, lower their sort of risk in their portfolios on uncertain news announcements. But the key is any significant changes, and if we do get any significant upside surprises in the inflation data, it could trigger concerns of stagflation. And stagflation is basically the situation where you have high inflation, slow economic growth, and high unemployment. But if there's a significant downside surprise, this could then trigger concerns of economic growth. So it's a pretty important report here, and we're expecting to see a lot of volatility around the US dollar pairs as well as the US stock market as well. So if there's any opportunities throughout the week based on this kind of data, and if it can set and trigger some really big trends and big moves in the market, I'll do my very best to update you. But make sure you're tuning into all the live trading webinars to find those trading opportunities throughout the trading day as well. For now, let's dive into the market and let's see what's going on there. Okay, so here in the market, we are on the 180 phase changer strategy on the daily chart, and something that's been highlighted from the smart charts London and Sydney trading floors is actually New Zealand dollar against the Canadian dollar, because actually what we have here are some pretty decent cycle formations developing off the moving average zone, in particular the larger moving average on the chart, the blue line, and this is also on a angle of price, a trend line, and also on this significant high point where price has actually broken through, and we've got a confluence of areas of support where buyers could potentially turn up. And on top of what Smart Chart is finding, this confluence becomes very interesting because we know this currency pair can trend pretty well, and sometimes we get just some very high volatility trends, sometimes we get some low volatility trends. Right now we're dealing with much more higher volatility because there's a lot more news announcements, we've had a lot more profit taken, but some algos still continuing the trend. So trends can sometimes change, well they definitely do change over time as well. But this is why we look for clues on market behavior so we can adapt to changing situations. Because if you look at these trends here, if I just zoom out a little bit more on this chart, so you can see this trend here developing off the blue moving average, a bit more higher volatility, okay, off this trend line. We had a trend developing here off the yellow moving average, a bit more lower volatility, but still a decent trend there. And you can see here on the far left hand side, look, we had a trend developing off the blue moving average first, and then it went into the yellow moving average. So actually the volatility of trends can change mid-trend as well. Sometimes they can start high volatility, go low volatility, and sometimes they might start low volatility and then go high volatility. But in this instance, we'll be looking for like the continuation of the trend here. We've got a lot of confluence of support areas where buyers may decide to turn up and continue driving this market higher. This also sits well with the theme of a weaker Canadian dollar on the disappointing jobs report that we had last week, and also the declining oil prices, which also can affect the Canadian dollar and cause that to fall as well, because a lot of their income is made from the export of oil to the US. So technically and fundamentally there are some interesting things going on here. So not only does smart charts help us to identify these opportunities, but also help us to do the really important work, which is risk management. Because if we click the buy icon here, populate the entry price of the blue dot, stop loss at the red dot, target the green dot. These can all be adjusted according to your own user preferences, of course. It'll also do the risk management calculations as well. Now it's important to keep that risk low to make sure that you're able to deal with the random distributions of wins and losses that develop throughout the day, throughout the week, throughout the month. And we like to set expiries, and on this particular strategy, current bar close expiry, and basically what that means is if buyers don't turn up by the close of this current daily bar, then this pending trade will just expire. Didn't win, didn't lose, didn't cost you anything. But if they do decide to turn up, either goes to your target level or it goes to your stop loss level. Okay. Now something else that's actually been highlighted on the trading floor is euro against the Swiss franc on the market breakout strategy, because we've had these periods of really good trends here to the downside, here to the downside, and we have been looking for this to continue to the downside here as well. All right, and we've sort of broken through these areas that the price was going up, so we're looking for this trend to continue to go lower. Now we've had a bit of a consolidation in the market, as we highlighted sort of beginning of the week, last week. We've already had some big trends, and now we're putting some trend reversals, some ranges. We're taking a bit of a breather as we come into the higher impact news announcements. So in this instance, what can happen is you can get these cycles developing off the moving average zone, moving average zone, and sometimes what can happen is that they can just consolidate a bit, and you can get these what we call mini chart patterns that develop in a trend. And what you have here, okay, is basically a wedge formation where price is making lower highs but also higher lows, and it's just basically the market taking a bit of a breather. But what we have here is we have price broken through it, and now we're looking for maybe the trend to resume the move. And you can see this in most pairs. You can see here as price moved in this phase 2, you can see it creates a type of trading range. In this instance, it's called a channel, okay, or flag pattern. So sometimes in those phase 2 moves, they can consolidate, go a bit sideways, and they might create some structures, okay, well-known chart patterns, and then when price breaks through those, then we can look for the continuation of the trend. And we're just looking to rinse and repeat really the situation that has developed here and here, and now looking for that continuation. And because we've broken through the bottom of that wedge formation, and we're actually retesting it here, aren't we? So we're going to use this as a potential area of resistance, and if sellers do turn up, then we want to be ready and waiting to try and participate in that price movement as well. Okay, it's a bit more of a positional trade than a momentum trade, but of course you're facing the T-wage, you're looking for momentum. Other trend strategies, you're looking for more positional setups. All right. So in this instance, not only do smart charts help us to identify that trading opportunity, but also do the risk management work as well. So if we click the sell icon here, for example, it will populate an entry price at the blue dot, stop loss at the red dot, target the green dot, and these can all be adjusted according to your own user preferences, of course. And it will do the risk management calculations as well. Important, keep that risk low, make sure you're able to deal with the random distributions of wins and losses that develop throughout the day, throughout the week, throughout the month. And then we like to set an expiry of the end of the day on this particular strategy, just to get a bit of a room to breathe and go towards the entry level, which is based on the fractals on the chart. Okay. Now that's kind of the basic version. Now for me personally, okay, because on this a positional trade, I personally like to lower my risk on positional trades and make sure I can also go for a higher reward to risk, because it's a bit more of an aggressive way to trade the market, because it's not in a momentum based market, and so you're waiting for price to maybe continue a move. It's just broken through a trading range, so it might not continue to move if it's just broken outside of a trading range. So for me personally, I like to lower my risk on positional trades. When we have high momentum, time frame agreement, then I'm happy to go in full percentage risk, 2%. But if you lower your risk here, for example, smart charts will already recalculate your stake per pip instantly, all right? So I don't even need to worry about that stuff. That's already done. And also, I like to go for, on positional trades, make sure there also is a decent reward to risk there as well. So in this instance, I would then look for maybe a 2-to-1 reward to risk, but also you need to make sure that 2-to-1 reward to risk is even achievable. And what we can see here is that, look, if our target level was here, it is achievable, right? Because there's no major horizontal support levels in the way. You know, it can get to the target if sellers did turn up and take control of this market, right? So for me, I just like to manage risk appropriately, depending on the market conditions and volatility levels. For being a trader, probably not doing that just yet, but that's because you're trading high momentum based markets where you already have a higher probability of success. But then when you actually start adding in other types of strategies, positional stuff, trading lower volatility conditions, then yes, you might allocate different risk percentages, tailoring to what the market is doing, all right? And actually then smart charts will already recalculate everything for me. So again, job done, all right? Okay, that's it from me. I'm going to wish you all the best with your trading today, and I'll see you next time. Bye for now.